Okay, it's time for us to begin to discuss some important concepts that are going to play a role in your trading and investing success. The first concept I would like to discuss is the debt-equity ratio. Simply the debt over the equity. Now, most things in trading or in markets are comparable to everyday life. So I want you to think of a house. Joe owns a house and the house is worth $600,000. He has a mortgage of $400,000. So you could say Joe's equity is $200,000. If he were to sell the house and pay off the mortgage, there will be $200,000 left. That's his equity. You could say that Joe has a debt-to-equity ratio of 2-to-1 based on this house. He has $2 in debt for every dollar of equity. That's pretty simple to understand. Well, businesses can be evaluated in a similar way. Debt-to-equity ratio. If a company is valued, say, at $600 million and has debts of $400 million, the shareholders' equity is $200 million. So in this case, again, the debt-to-equity ratio is 2-to-1. Now, you want a low debt-to-equity ratio. That means the company's well-financed. They have plenty of money to pay their bills. The higher the ratio, the more dangerous the company is to own. In other words, a high ratio means there's aggressive financing going on. They're borrowing a lot of money, and that's a higher risk situation. It's something you want to avoid if you're going long, but it's also something you might want to take advantage of if you're thinking of selling short. Let's also talk about profit margin. What is it? Well, what is profit? First of all, revenue minus expenses is profit. And profit over revenue is profit margin. Let's take a closer look. Let's say a company has $1 billion in revenues. In other words, it has $1 billion coming in during the course of the year. It spends $800 million to earn that billion. So we say it has expenses of $800 million and revenues of $1 billion. $1 billion minus $800 million leaves the profit of $200 million. We could say that this company has a 20% profit margin. Now, what do we really look for when we're looking at profit margin? I want to know, is that profit margin growing or is it shrinking? You see, if the profit margin is shrinking, that's a warning sign. It means that the company is either spending more on advertising or it's in a pricing battle with its competitors. No matter what the reasoning is, shrinking profit margin is a warning sign that you should not be long that stock. Conversely, you may want to short that stock or maybe use that not as the determining factor as to whether or not you're long or short that stock, but use it as one of the factors to make that decision. All right, let's talk about dividends. We haven't spoken about dividends at all, but we're swing traders. We might be in positions for a while, and that means we might receive some nice dividends. This is a great little bonus. You know all that money you pay in commissions to get in and out of trades? If you're hanging on to the trades long enough and there's a nice dividend involved, you're going to get some of that back. Okay, so what is the dividend yield? It's the annual dividend rate divided by the price of the stock. This measures how much cash from dividends you get per dollar invested. So let's say two companies both pay a dividend of $1 per share every year. ABC trades at $20 and XYZ trades at $40. We could say that ABC has a dividend yield of 5%, while XYZ has a dividend yield of 2.5%. Now, when you're looking at dividends, I don't want you to only look at the dividend yield. This is a big mistake that many investors and traders make. They look at the yield and they say, oh, I like that dividend yield. Let's buy this stock. No, don't do that. what I want you to do before you dive into a stock based on the dividend or using the dividend as a supporting factor, first I want you to look at the dividend history of the stock. You can find it on NASDAQ.com. You want to know, is that stock stable? You need to beware of companies that suddenly offer a large dividend. You know, you get that all the time. People say, oh, that dividend looks great. I want to buy that because they see the big dividend. But you know, what I want to ask is, how many consecutive quarters has that dividend been paid? Does the company increase the dividend on a regular basis? You want to see a nice, stable history of gradually and slowly increasing dividend payments. Dividends add up. A swing trader who collects a healthy dividend can earn enough money to improve their performance. And believe me, in this business, every little bit counts. So you definitely want to improve your performance any way you can. Now let's look at NASDAQ.com. This is an example right here of a company that has a nice, stable dividend. You'll notice that the dividend is paid every quarter without fail. The company is gradually, slowly increasing the dividend every year. We love to see that. That's stability. That dividend is probably going to stay. You can count on that dividend continuing. On the other hand, let's look at a company where the dividend is all over the place. It goes up, it goes down. This is much less trustworthy in my opinion. If I saw a dividend history like this, there's no way that I would buy that stock if I was really focused on the dividend. Now, maybe there's some other factor that might encourage me to buy that stock. But based on the dividend alone, this is not a buy because they have a very irregular, unstable history of dividends. They could pull the rug out from under you at any moment. Now I want to share with you a concept that we're going to use in a trading strategy in just a few minutes. This is called current ratio. Current ratio is current assets over current liabilities. Now, what does that really mean? We're simply measuring the ability that a company has to pay its bills. Not in the long run, but in the short term. It's just like someone you might know who has just enough money coming in to pay the bills every month, right? Well, companies are like that too. There are companies who have just exactly enough money coming in the short term to keep the lights on, right? So if a company has a high current ratio, that's great. That means they have plenty of money to pay the bills. If a company has a low current ratio, that's bad. Now, generally, we use 1. The number 1 means, a current ratio of 1 simply means that the money coming in is equal to the money that is needed to go out. If a company has a current ratio of less than 1, that means they are having trouble paying the bills. And that's never a good sign. So certainly, if we're going long, we want to go long companies that have a current ratio of above 1. And conversely, if we're going short, we're going to short companies that have a current ratio below 1. And I'm going to show you how to use that in a trading strategy in just a few minutes. Now, a low current ratio says that the company is not in good financial health. That doesn't mean it's going to go bankrupt. Because remember, they can always borrow more money. They can always gain access to more financing. But you know what? Borrowing money to pay your bills is never a good sign, whether it's an individual or a company. And so you definitely want to avoid those type of companies, a current ratio of less than 1, if you're going long. One last concept here is the quick ratio. Quick ratio is very similar to current ratio, except we remove inventories. So it's current assets minus inventories over current liabilities. So really, this makes it a little bit more of a conservative number. It's why? Because inventories are not always easily convertible to cash. And think of a sporting goods store. They sell jerseys for a sports team. And suddenly that league goes on strike. What's going to happen to those jerseys? They're just going to sit there, right? They might not be able to convert that inventory to cash. And if they're depending on that to pay their bills, they're out of luck. Or suppose the team trades away their star player, okay, and the sporting goods store has 50 jerseys with that guy's name on it hanging on the wall. What are they going to do with those jerseys? They're useless now, okay? So when a company has to hang on to its inventories, they have to pay to store them. Some certain types of businesses, the inventory can go bad, it can spoil, or it can just become outdated. So using the quick ratio, taking the inventories out of the equation, is an even more conservative way to tell if a company can pay its bills. Now, before we wrap it up, I want to ask you a question. Are we buying growth or are we buying value? Money has a tendency to rotate during good times and bad times from one to the other. Let me explain. Generally, in a bull market, you would want to own growth stocks because they have a tendency to outperform. When the market turns less bullish or bearish, money tends to rotate out of growth and into safer, high dividend stocks with good, stable dividend histories. Okay, a healthy dividend acts as a cushion in a bad market. So those stocks, as they go down, the dividend yield is actually rising because the price is going down. The dividend stays the same, but the yield actually goes up and it becomes attractive. And this acts like a parachute on the way down. They don't fall as fast. And they're much more stable. They're better to own in a bad market. So you would prefer to have those value stocks. We call them widow and orphan stocks. You know, the big names that they're not really exciting, but they pay that dividend and they always pay the dividend. And then when the market turns bullish, money tends to rotate out of those stocks and it tends to rotate into what we call the growth stocks, the high octane stocks, because people, when that market is moving, when that bull market is taking off, everybody's trying to maximize it. So they start selling those high dividend stocks, those widow and orphan stocks, and they try to make the most out of that bull market by getting long some good growth stocks.